Ladies and gentlemen, welcome to the Q3 Hong Kong strategy in stock picks. Where are the rising stocks? I'm Brian, your MC for today. Before we start our program, let me do a quick survey. Please help me to vote in the poll that has been sent out. Thanks for the voting. During the webinar, if you have any question, do type them in the chat box, and I will address the question during the Q&A session at the end of the session. As usual, I need to emphasize on our disclaimer, where this presentation has not been reviewed by Securities Commission Malaysia and does not constitute any recommendation. Honorable guests, ladies and gentlemen, greeting and good evening to Mr. Wong and those joining with us today. With Phillip Capital Sdn Bhd, are honored to welcome all guests participants to participate in Q3 Hong Kong strategy and stock picks. Where are the rising stocks? With Mr. Wong, Executive Director and CIO of Phillip Capital Management Hong Kong. First, I would like to start off our session with a short introduction of Phillip Capital Sdn Bhd. What is Phillip Capital Sdn Bhd? Phillip Capital Sdn Bhd incorporated on 7 October 1995. It is wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. It formerly known as Phillip Futures Sdn Bhd. Phillip Capital Sdn Bhd is trading participant of Bursa Malaysia Derivative Bhd, participant organization of Bursa Malaysia Securities Bhd, and it also holder of Capital Market Services License, CMSL. So Phillip Capital, we are multinational company. Our headquarters located in Kuala Lumpur, and we have 11 Phillip Investor Centers across Malaysia. Sarawak, we have Phillip Cebu and Phillip Kuching, and then Sabah, we have Phillip in Kota Kinabalu, and also some other branches in Peninsular Malaysia. Next, we did also receive some award from Bursa Malaysia. So from 2017, we get Best Overall Derivative Trading Participant, second runner-up, and then along 2018 to 2022, we get Best Overall Derivative Trading Participant, and we also get Best Institutional Derivative Trading Participant. So the latest year, 2022, we get first runner-up of Best Retail Derivative Trading Participant and second runner-up of Best Overall Derivative Trading Participant. For our global network, we have our branches in France, Turkey, Malaysia, Singapore, United States, United Kingdom, and other countries. For our global coverage, we have CME Group, Chicago Board of Trade, NIMEX, and Hong Kong, Bursa Malaysia, SGS, and so on. Phillip Capital is your one-stop solution for your trading. Our products, we're having 3 categories of products, which are futures, consists of index future, agricultural futures, metal futures, energy futures, and interest rate futures. For stock, we're having Malaysia shares, US shares, Hong Kong share, and so on. Contract for difference, we're having Bursa share CFD, NYSE share CFD, US index share CFD, and Nasdaq shares CFD. Phillip Capital is also your broker of choice. We are a world-winning multi-asset broker, 24-hour broking and execution support, advisory services. We did provide latest market news, wide array of products, and online account opening. Learn with Phillip Capital. What can you learn from us? You can learn free one-to-one coaching session, free seminars and webinars. Like tonight, we are hosting a free webinars, and we're also having free account opening. For free one-to-one coaching session, basically it will cover introduction to futures, CFD, stock trading, platform coaching, charting system, and also product knowledge. So this is our QR code for upcoming seminar and webinars. If you wish to listen more session with our distinguished guest tonight, Mr. Wong. Please scan the QR code to register for our upcoming events. For our weekly market, we're having market views updates and live counter technical analysis. Both of these will be carried on every Monday. For market view and updates will be every Monday 11:15 a.m. For live counter technical analysis will be every Monday 8 p.m. Phillip Capital, we did provide one-to-one online account opening as well. So the online account opening consists of stock account, futures account, and safety account. And here are some trading platforms. We're having Phillip Nova. We're also having Poems. And last will be our Phillip CFD Trader, basically trade for CFD. Last will be our promotions. So here are some of our marketing campaign. Trade on with Phillip. You may scan the QR code for more info. And we have also frozen stock Vista. Trade US Index CFD as USD2. So next, before I pass the floor to our distinguished speaker tonight, Mr. Wong, please let me to have short introduction of our speaker. So Mr. Wong is Executive Director and CIO of Phillip Capital Management Hong Kong. He is one of the most experienced fund managers in Hong Kong. He has over 30 years of solid experience and track record in the financial market. His stock selection criteria is stringent, which insists on having a thoughtful understanding and sophisticated analysis of the company before making investment decisions. He is now the host of certain financial programs of Radio and Television Hong Kong, Hong Kong Hoi TV, and Hong Kong Metro Radio. He has been awarded by the Putonghua channel of Radio and Television Hong Kong as the best financial analyst for 3 years. In addition, he was the financial columnist for Hong Kong Economic Times, Oriental Daily, Ming and Yahoo Hong Kong. Mr. Wong is the author of 3 popular investment guidebooks. He has also served as part-time instructor of several investment courses in various Hong Kong universities. City University of Hong Kong, Polytechnic University, Hong Kong, and Lingnan University. Today, Mr. Rees will speak about Q3 Hong Kong strategy and stock picks. Where are the rising stars? Mr. Rees, you may now take the floor, please. Yeah, Mr. Rees, have you started the session? We can't hear anything from you.
Hello, Mr. Lewis. All right, I think
Yes.
we can hear your mic now.
Yeah,
we can hear you.
Yeah. Okay. Sorry for the delay. Hi, good evening, everybody. This is Louis Wong. Tonight, I will share with you our Hong Kong strategy and also our ETF and stock picks for the third quarter. Okay, these are my key discussion points tonight. I will review with you the performance of the China and Hong Kong stock market so far year to date, so far this year. And then we explain to you what are the headwinds and tailwinds the stock market is facing currently. And then also we'll go through an overview of China's economy and share with you our 2023 outlook for China. And investing in Hong Kong and also in the A-share market would also, the Yuan currency will impact the investment return. So I'll also share with you our outlook on the Chinese Yuan. Then it will follow by our major index forecast range for the third quarter, and then our ETF and stock picks. I presume a lot of investors will have interest in the tech companies listed in Hong Kong, namely the A.T.M.J, Alibaba, Tencent, Meituan, and JD. So I will also share with you our take on these tech giants, tech companies. Okay. The Shanghai Composite Index was up 6.4% year to date, up to last Friday. My slides were up to last Friday. So not bad because of the rally mainly came after the holding of the Politburo meeting early this month. So expectations that China will roll out a series of economic stimulus policies help support the A-share market recently. Shanghai Composite Index was up 6.4% year to date. The Shenzhen Component Index underperformed slightly compared to the Shanghai market. Shenzhen was only up 2% year to date. As for Hong Kong, the Hang Seng Index underperformed the A-share market. Hang Seng Index was down 1.2% year to date. You can see that after rising to above 20,000, recently the Hang Seng was back below 20,000 again. Let me explain a little bit, because the constituent stocks of the Hang Seng Index are quite heavily concentrated in property developers, Chinese property developers, banking stocks. And these two, the banking sectors and the property sectors, are not faring very well recently, so they dragged down the Hang Seng Index together with local property stocks. If you are familiar with Cheung Kong, Sun Hung Kai, and Henderson Land, because of the sluggish property market in Hong Kong so far this year. But the Hang Seng Tech Index outperformed the Hang Seng Index. Year to date, it was up 8.9% up to last Friday. You can see the performance much better than the Hang Seng Index. Okay, so what are the headwinds the stock market is facing? First of all, China's post-COVID economic recovery loses steam, and deflation fears are on the rise. Later, I will share with you, China announced the July CPI and PPI today, and both CPI and PPI are in negative territory, signaling deflation. So deflation risk is heightening. And then recently, China is exposed to different natural disasters, including flooding, heat wave, and also these are the natural disaster adding pressure to economy. US underlying inflation remains sticky. As you can see, the core CPI in the US remains around 4%. So the Fed would not start cutting interest rate very soon. So this is also one of the headwinds the stock market is facing. And a weakening Chinese yuan may trigger further capital outflow because of weakening Chinese economy, as well as the widening interest differential between the US and China. In addition, US-China tension intensifying given friction over Taiwan, South China Sea, and the tech war. So these are also one of the headwinds the stock market is facing. As I mentioned just now, Chinese developers' debt woes continue amid renewed home sales softness and a lack of aggressive stimulus. One of the major developers, Country Garden, which is also active in Singapore and Malaysia, recently again saw renewed debt default problems. So the developers' debt woes continue. And the big tech firms, they see their earnings growth stalling because of rising competition, especially in the e-commerce aspect. For instance, Pinduoduo is competing against JD as well as Alibaba. So competition in the e-commerce aspect is getting more intense. However, there are some tailwinds, at least some tailwinds to offset the headwinds. So on the one hand, U.S. rate hike cycle may be nearing an end. The rate hike cycle may be done, or at most there is market expects that there is only one more rate hike by the Federal Reserve. And recent economic data shows that a US recession appears less likely. So soft landing is expected. And I mentioned earlier, China's Politburo meeting held early this month has raised expectations for more economic stimulus. And China vows to create a bigger, better, and stronger private sector. These two tailwinds explain why the tech index outperformed the Hang Seng index recently. Is because there's a change in policy direction. First of all, China now is more friendly, more supportive to the private sector versus, I mean, the more hostile attitude it has adopted in the past. And China also sends strong signals that it will support platform firms such as Alibaba and Tencent. So this has changed the headwinds in the market. Okay, overview of China's economy and 2023 outlook. At the start of 2023, China's economy showed a mild but mixed recovery. First quarter GDP grew 4.5% year-on-year, above expectations. Second quarter GDP grew by 6.3%, but don't be tricked by this number, because the growth was due to low base effect last year in the second quarter 2022. If you look at the quarter-on-quarter basis, China's GDP only grew 0.8% in the second quarter versus 2.2% quarter-on-quarter growth in the first quarter. So it signaled a slowdown in the economic growth in the second quarter. Why is it so? Recent recovery has been hit by rising youth unemployment, disappointing retail sales and industrial production, also an entrenched property downturn and mounting local government debts, as well as weakening global demand and deflationary pressures. In the past, China tends to rely on infrastructure investment to support the economy. But infrastructure investment heavily relies on the issuance of new special bonds to maintain a high growth rate. But there may be pressure on this source of funding following the concentrated issuance in the first half of the year. If revenues from land sales remain limited in the third quarter, because a lot of provincial government, their income, the revenue relies heavily on land sales. Now with the property market being very sluggish, revenue from land sales would decrease, and that would undermine provincial government's capability to invest in infrastructure. Okay, the industrial sector is also under pressure, mainly due to the global economic downturn, which has hampered industrial exports, as well as insufficient domestic demand. Youth unemployment, the unemployment rate surged. Latest reading was 21% of 16 to 24-year-olds population in China are unemployed. That means 21% are out of a job at the end of June. Okay, but it is suspected that the actual youth unemployment rate is even much higher than the official data. It can be as high as 40%, 40%. To support the weakening economy, the Central Bank of China, the People's Bank of China, cut key lending benchmark rates in June, trying to shore up economic activity. But because of the US interest differentials widening, so the room for rate cut in China remains rather limited. So every time the PBOC cut interest rate by only 10 basis points, not sufficient enough to stimulate the economy. Recently, the China's National Development and Reform Commission, NDRC, unveiled 20 administrative measures to spur domestic spending that covers car consumption, as well as food and catering, and travel. But it's still too early to say whether these administrative measures will have a significant effect on stimulating domestic spending. Okay. Now let's look at the key economic data. All points to the fact that economic growth is slowing down in China at the moment. So real estate investment drop deepens. China's fixed asset investment growth, as shown on the left hand on the chart in the chart on the left hand side, slowed to 3.8% from 4% in the first 5 months. Mainly dragged down by property investment. Property investment in the first 6 months this year was decreased by 7.9%. But if you look at June's drop, property investment fell 20.6% from a year earlier in June, after a 21.5% drop in May, which is due to weak confidence and also potential oversupply problems and challenges facing the cash-strapped developers. Okay, real estate investment property sales remain weak. June property sales fall at the fastest pace this year. On the left-hand side, you can see the property sales up to June. The blue line represents sales in terms of floor area, whereas the blue line represents sales in terms of value, property value. Yellow line is sales in terms of floor area. So for January to June, property sales by floor area were down 5.3%, year-on-year, compared with a 0.9% fall in the first 5 months. So the fall deepened in June. Property sales by floor area declined 28.1% year-on-year in June. So that's one single month. Year-on-year, down 28.1% in June, extending a 19.7% fall in May. At the end of June, the area of commercial housing for sale, this represents the unsold inventory, was 641 million square meters, a year-on-year increase of 17%, among which the residential area for sale increased by even more, by 18%. The chart on the right-hand side is the real estate climate index, which is representation of confidence or optimism among property developers. So it plunged to 94.06. A reading above 100 means generally property developers are generally optimistic about the outlook. Below 100 means property developers are pessimistic. So you can see the real estate climate index in June, it fell to 94.06 in June, signaling the pessimism among property developers at the moment. Okay, on the industrial production side, China's industrial output grew 4.4% in June from the year earlier, slight rebound from the 3.5% growth in May, but still below the 5.6% growth recorded in April. Demand remains lukewarm amid the bumpy post-COVID economic recovery. And the chart on the right-hand side shows industrial profits. Actually, industrial profits tumbled very severely in early this year. The drop deepened to 20.9%. So over the last 4 months, the decline in industrial profit narrowed slightly for 4 consecutive months, thanks to improved profitability in the equipment manufacturing sector, but it was still down 16.8% compared to a year ago. Retail sales is one troubling, headache area for the Chinese government. The growth rate slowed down from 18.4% in April and also 12.7%. But I also wish to point out the fast growth in April and May was mainly due to a low base effect last year, when most part of China is under COVID lockdown last year. So with a low base effect, retail sales in April and May this year register double-digit growth. But back to when this low base effect disappear, in June, the growth rate slowed down to 3.1%. Okay, yesterday China announced its trade data for July, which saw double-digit plunge in both exports and imports. Very bad. This chart only was done last Friday, so before the release of the July data, you can see blue line is exports. Exports was down 12.4% in June, and import was down 6.8% in last month, as the month before last month, in June. But in July, the trade situation in China worsened, deteriorates. Exports fell by 14.5% in July from a year ago, while imports dropped by 12.4% in both in US dollar terms. Exports to the US plunged by 23.1%, partly caused by the tension between China and the US. But to the European Union, exports from China fell by 20.6%, partly because of high inflation and weak economic growth in the EU, in the European zone. Exports to the ASEAN is also disappointing, which fell by 21.4%. Among the few high-value export categories that saw a significant increase, there's some silver lining, which is seen among car exports, export of refined oil, and export of suitcases. So these sectors, these items saw a significant increase in the first 7 months this year. So the car industry are the very few rising stars. Car makers are the very few rising stars currently in the market. Okay, today China announced the July Consumer Price Index and Producer Price Index. Both are in deflation territory. You can see on the left-hand side, this chart shows the CPI. See, China's CPI fell by 0.3%. In June, it was flat. Before June, it was still in positive territory. But in July, CPI fell by 0.3% year-on-year, which is the first drop since February 2021. The PPI on the right-hand side, you can see the blue line fell by 4.4%, slightly narrowing from the 5.4% drop in June, but marking the 10th consecutive months of contraction. So deflation risk have heightened and will continue to weigh on the economic recovery. Okay, let's look at the Purchasing Manager Index. Both official managing PMI now are in contraction. The official manufacturing PMI, as you can see in the chart on the right, on the left-hand side, it rose slightly from 49 in June to 49.3 in July, but still remain in contraction. Below 50 signals contraction. It remained in contraction for the 4th straight month. And the Caixin manufacturing PMI also returned to contraction, coming in at 49.2 in July as against the 50.5 reading registered in June. On the right-hand side, the chart shows the official non-manufacturing PMI, which is also declining. The official non-manufacturing PMI fell from 53.2 to 51.5 in July, although the Caixin non-manufacturing PMI improved slightly to 54.1 in July from 53.9 in June. Okay, so the outlook remains a bit downbeat lah. China sets a GDP growth target at around 5% for 2023, which is considered moderate following a low base in 2022. Premier Li Qiang reiterated that China is on course to achieve its 5% target for economic growth this year. And we do not expect policymakers to unleash major stimulus as the 5% GDP growth target is still well within reach. In the first half this year, China GDP grew by 5.5%, but third quarter it may be lower because of slower growth as demonstrated by the economic data which I showed you earlier. So we reckon that policymakers need to adopt a more targeted approach to tackle issues such as property risk and youth unemployment. And a weakening yuan and widening yield differentials with the United States will continue to limit the scope for any substantial monetary easing. The PBOC will likely cut the RRR. RRR stands for Bank's Reserve Requirement Ratio. By cutting the RRR, that means commercial banks have more funds to lend out to borrowers. So the PBOC will likely cut the RRR and interest rates again. We expect a RRR cut in the third quarter this year and another interest rate cut in the fourth quarter. So in conclusion, we forecast 5.2% GDP growth for China in 2023. Okay. The yuan outlook, the Chinese yuan has been on a weakening path over the past 3 months, testing its weak point against the US dollar at 7.3 back in 2022. I'm referring to offshore yuan. This is a result of a sluggish recovery in China and also widening interest rate differentials with the US. The interest rate differential based on difference between China and US 1-year interest rate swap rates currently sits around minus 3.4% and is expected to widen further if China continues to cut interest rate. China, however, recently ramped up yuan support with a stronger than expected reference rate and also raising a perimeter on cross-border corporate financing under its macro-prudential assessment, which is abbreviated MPA, to 1.5 from 1.25. What is the meaning of raising this parameter? Means Chinese enterprises, they are allowed to borrow more money offshore. So by borrowing more money offshore, they will borrow more US dollar. So it will improve the US dollar liquidity onshore and will help to relieve the downward pressure on the yuan. That's how it works by raising the MPA. Besides that, also the PBOC encourage commercial state-owned banks to do yuan buying trades to support the yuan. So recently the yuan stabilized below 7.2 to 1 US dollar. Going forward, factors that may reverse the yuan's weakening trend include the stronger Chinese stimulus policy. If there is a stronger stimulus policy that can regenerate momentum in economic recovery and boost capital inflows. On the other hand, if the US interest rate has proved to have peaked, and also China's improving trade surpluses from greater trade between China and global South countries, these factors may reverse yuan's weakening. But without those factors, we do expect the yuan to remain under pressure against the US dollar. Our forecast range for the offshore yuan is between 7.1 to 7.3 for Q3. So currently it's around 7.19 in the middle of this range, this forecast range. Okay. Then we come back to the stock market. The below our index forecast range. So for the Hang Seng the Shanghai Composite Index, we expect a range between 3,150 to 3,400. Currently is trading around 3,250, 3250. So we expect a range of 3150 to 3400. Resistance is expected around 3,400, but support expects to be around 3,150. For the Shenzhen Component Index, we expect resistance around 12,200 and support around 10,500. So our forecast range for the Shenzhen Component Index in the third quarter is between 10,500 and 12,200. Hang Seng Index, our forecast range is between 18,000, which is the low seen in May this year, end of May, and 21,000 around the resistance level seen in early March. So we expect this range between around 3,000 point range between 18,000 and 21,000. As for the Hang Seng Tech Index, we are expecting a range of between 3,850 around here and 4,800 as it manages to outperform the Hang Seng. And I explained earlier, because of policy, the change in policy directions. Now the government is more supportive to private enterprises as well as tech companies. I think the hidden agenda is to hope that those private enterprises and platform companies, tech companies, will employ more younger people so as to bring down the unemployment rate. So they roll out supportive policies. Because we are more upbeat on the Hang Seng Tech Index, so among the ETF picks, the Hang Seng Tech Index ETF is one of our ETF pick. This is the Hang Seng Tech Index ETF managed by CSOP. The stock code, the ticker is 3033 Hong Kong. This is the basic fund information. The ETF was listed in 2020 August, and it aims at full replication of the Hang Seng Tech Index. Management fee is all in, including the other expenses, is around 1%. Okay. Ongoing charges is around 1.05%. The base currency is Hong Kong dollar, and the number of holdings, maximum number of constituents is 30 stocks, 30 constituents. Okay. This is the sector breakdown of the index and also the Hang Seng Tech Index ETF. 48, close to 46% belong to consumer discretionary. Communication service account for 27.56%, and information technology accounts for 23.6%. Healthcare only accounts for less than 2%, and financials only account for 0.9%. So this is the sector breakdown of the Hang Seng Tech Index ETF. Okay, the top 10 holdings comprise some of the EV startups, such as Li Auto, which is very strong recently, and then followed by Meituan, Kuaishou, Alibaba, Xiaomi, JD, Tencent, NetEase, Baidu, and Xiaopeng. Okay, so all the A.T.M.J are all there among the constituents of this tech index ETF. Okay, you can see support around $4.10 to $4.15. So we expect strong support around 4.10 to 4.15. Okay, and our target for the third quarter for 2023 would be around 4.75. So there's a 15% upside. Okay, the other ETF I would like to introduce to you is the one managed by Phillip Capital Management Hong Kong. It is known as Phillip Hong Kong Newly Listed Equities Index ETF. The ticker is 2835 Hong Kong, 2835. This ETF is a passively managed ETF. It aims to fully replicate the Solactive Hong Kong newly listed equities index, a rules-based equity benchmark designed to track the performance of securities that had a recent IPO, initial public offering, or new listing on the main board of the Hong Kong EX. The index is rebalanced quarterly, incorporating securities with IPOs or new listing within the last 756 business days. That means that it's more or less close to 3 years. That means those companies listed in the last 3 years will be selected into the index. After 3 years, they would be removed from the index. So the total number of constituents is more than the Hang Seng Tech Index. This newly listed equities index has a total 50 securities, 50 stocks based on free float market capitalization. And the index also undergoes monthly IPO reviews to include recent IPOs. So it will admit add new companies every month, which are listed. The new listings, subject to, of course, subject to liquidity and market capitalization criteria. Okay. IPOs provide a unique chance to invest at the ground level in companies that could be the next big thing. So we believe that there's always the next Alibaba, the next Tencent, the next JD. So by investing in newly listed equities index ETF, investors are able to capture the next Alibaba, the next Tencent. From biotech startups with cutting-edge solutions to green technology firms, paving way for a sustainable future. So IPOs represent immense growth potential. Also worth to note is strategic reforms enacted by the Hong Kong Exchange in 2018 unlocked the gateway for emerging innovative companies to go public. A lot of biotech companies, high-tech companies, they are now eligible to be listed on the Hong Kong Stock Exchange, propelling Hong Kong to its status as a leading center for IPOs globally. The end of US interest rate hikes, the complete opening of Chinese and Hong Kong borders, and also relaxed listing rules and upcoming IPOs of Alibaba's business units will help revive the Hong Kong IPO market. So Deloitte's Capital Market Services Group projects about 100 new listings in Hong Kong this year. In the first half, there were only around close to 37 listings. So we expect more new listing in the second half. The total fundraising this year is expected to be around 180 billion Hong Kong dollars. Okay. This is the sector breakdown of our Hong Kong newly listed equities index ETF, which is more diversified than the Hang Seng Tech Index ETF. Hang Seng Tech Tech Index ETF, as I showed you just now, 45% in consumer discretionary. Here, the 32% come from consumer discretionary, a lower percentage than the Hang Seng Tech Index, followed by 28% in consumer staples. In healthcare. So consumer healthcare accounts for a much higher proportion weighting in this newly listed equities index ETF. With China's aging population, we believe that demand for healthcare demand will continue to grow steadily in future. And then the other two sectors which account for 10% of the index are communication services, as well as real estate, each accounting for about 10%. Okay. The top 10 holdings slightly different from that. We don't have Alibaba anymore. We don't have Tencent. Those companies are already entering the low growth phase. So the top 10 holdings are still in the fast growth phase. Tech companies in the fast growth phase, such as NetEase, Baidu, and the three startups EV startups are all in the among the top 10 holdings, including Li Auto, NIO, and Xpeng, Xiaopeng. Yum China and Trip.com, which are not in the Hang Seng Tech Index, are also among the top 10 holdings in this newly listed equities index ETF, IPO index ETF. So it's more diversified more diversified between new economy and old economy. There are some old economy companies such as Yum China and Nongfu Spring, Nongfu Sanquan, the company selling mineral water in China. Okay. This is the relative performance of 2835, the Hong Kong newly listed equities index ETF. The blue line is 2835. It outperformed the Hang Seng Tech Index, represented by the brown line, and clearly outperformed the Hang Seng Index, which is the green line. The Phillip Hong Kong newly listed index ETF recorded a monthly gain of 17.9% in price in July, much higher than Hang Seng Index 6.1% monthly gain and Hang Seng Tech Index 16.3% monthly gain. Year to date, it was up 13.7%, outperformed the Hang Seng Index and Hang Seng Tech Index, which gained only 1.5% and 10.2% respectively. Okay. This is the fund information. Our ETF, Phillip Hong Kong newly listed equities index ETF, was listed in November last year. Management fee is 0.6% and ongoing charges is around 1.5%. There's no dividend distribution intended. Number of securities, 50, more diversified. Okay. Our stock picks, where are the rising stars? We reckon that EV makers, electric vehicles makers, are the rising star in China at the moment. Okay. In 2022, passenger EV sales in China reached almost 5.67 million units, indicating a remarkable 90% growth compared to the previous year, and exceeding its 2025 target of 5 million units. So 2025 target reached in 2022, 3 years in advance. China's EV sales are expected to exceed 8 million units by the end of 2023. So far in the first quarter this year, China's passenger EV sales grew 29% year over year. Battery EVs, BEVs, made up nearly 70% of the sales, and plug-in hybrid EV, PHEV sales surged 88% year on year. The top 10 automotive groups, encompassing 28 brands, collectively accounted for over 80% of the total passenger EV sales. So it's very concentrated. Top 10 best-selling models collectively accounted for nearly close to 50% of China's passenger EV sales. With the rise of low domestic EV makers, especially the startups, foreign brands like Volkswagen, BMW, Mercedes-Benz, Hyundai, and Nixon experienced a combined 4% points decrease in market share compared to a year ago. but one exception is Tesla. Tesla stands out as an exception. The price war it triggered had an adverse impact on domestic EV startups, especially smart EV brands such as NIO, XPeng, and Neta. Smaller EV makers could be most vulnerable in a prolonged China price war due to their thinner margins and dwindling cash reserves. So this is the downside risk investors need to take note of. Why we think EV makers, the EV auto industry is a rising star? Because there are supportive policies to continue to boost EV market's growth. The Chinese government increasingly views electric vehicle as a crucial pillar of its economy and the country's green transformation, aligning with its broader goals of reducing carbon emissions, improving air quality, and enhancing energy security. In May 2023, the China's Development and Reform Commission, NDRC, released a strategic document aimed at promoting EV adoption in rural areas. This will encourage auto manufacturers to introduce more affordable models, enhance sales system, and facilitate trade-in services for rural consumers. China has recently extended its EV tax exemption policy until 2027. So there is very clear visibility in terms of tax policy. Under the extended policy, EV purchase in China between January 1st, 2024 and December 31st, 2025. That means for the next 2 years, EV will enjoy an exemption from the purchase tax amounting to as much as 30,000. Sorry, there's a typo error here. It should be 30,000 yuan renminbi, equivalent to 4,170 US dollar per vehicle. And starting from January 1st, 2026 until December 31st, 2027, the tax, also another typo error, sorry about that. The tax exemption will be halved in the 2 years from 2026 to 2027. And the per unit exemption amount will be kept at a lower amount, a smaller amount, that is 15,000 yuan. Compared to 30,000 yen in the next 2 years, signaling a gradual reduction on government support. Okay, so on the one hand, it will receive support from the Chinese government. On the other hand, we see big overseas potential for China's EV makers overseas. Chinese EV makers now feel an increasing urgency to expand overseas as consumer demand weakens amid an economic slowdown, and also Tesla's aggressive price cuts heighten domestic competition. In 2022, China's EV exports stood at 679,000 units, up 1.2 times year on year, according to the China Association of Automobile Manufacturers. The figure is expected to reach 1 million units this year, so about 50% growth, year-on-year growth. Chinese car makers are expected to capture around 15% of Europe's EV market by 2025, as players such as BYD, NIO, and Li Auto are gaining popularity among European consumers. EV sales are currently still low outside the major markets, but 2022 was a growth year in India, Thailand, and Indonesia. So collectively, sales of electric cars in these countries more than triple compared to 2021, reaching 80,000 units. So compared to China, it's still China. I mentioned last year, more than 5 million EV were sold, but India, Thailand, and Indonesia, the combined sales is only 80,000 units. So there's a lot of room for growth. For Thailand, the share of EV in total sales came in at slightly over 3% in 2022. In China, the penetration rate now is more than 30%. So we expect in other countries, the penetration rate of the EV penetration rate will also go up. And China will be very competitive. They have a competitive advantage because of the pricing by the EV makers. Middle East is also another growth potential, which has a nascent EV market, offers potential for growth. According to one industry report, for demand for EVs in the UAE area is projected to grow by an annual rate of 30% between 2022 and 2028. And meanwhile, the increasing level of government-level interactions between China and the Middle East, especially Saudi Arabia, is offering reassurance for automakers to invest in the region. Okay, there's another positive factor also lending support to the EV industry in China. That is rising foreign interest in Chinese EV makers. For instance, NIO, the ticker, the stock code is 9866, received $738.5 million US investment from an Abu Dhabi government-backed firm, CYVN Holdings. And recently, the Volkswagen Group reached an agreement with Xiaopeng XPeng to buy a 4.99% stake in the company, and they will co-develop 2 EV models for the Chinese market. The deal will give Volkswagen access to XPeng's technologies, including the Advanced Driving Assistance System, ADAS, in its effort to tap into China's fast-growing EV market. So foreign car makers are generally behind the curve compared to domestic makers. So now they want to catch up by forging alliance, collaboration with domestic EV makers. It is reported that another EV startup called Leap Motor, which is also listed in Hong Kong, the stock code is 9863. It was reported that Leap Motor was in advanced talks with 2 foreign companies about partnership, including Volkswagen and a new player in the electric vehicle segment, which could produce Leap Motor developed models in overseas markets. So we expect more investment, foreign investment into Chinese EV makers in future, and also more partnership or collaboration between foreign and Chinese EV makers. Okay, our topic among Chinese EV makers is BYD. As you can see in this slide, BYD secured its leading position with 79% sales growth in the first quarter and 9.8 points increase in market share. Okay. In the first quarter, all of the top 5 best-selling hybrid EV models belong to BYD. This is hybrid. You can see Song, Din, Tang. Denza is associate company under BYD. So all the 5 top 5 best-selling hybrid models were manufactured by BYD Auto. As for pure EV, BEV models, among the top 5 best-selling BEV models, 2 are manufactured by BYD Auto. Besides Tesla's Model Y, BYD's Yuan Plus and Dolphin are among the top 5 best-selling BEV models. Okay, BYD sold a record 253 vehicles in June this year, up from 240,000 in May and 210,000 in April. In July, it sold more than 280,000. So every month, you saw the increase, the steady increase. For all of second quarter, BYD sold more than 700,000 vehicles, up 27.4% versus the first quarter. By comparison, Tesla delivered 466,140 BEVs worldwide in the second quarter, much less than BYD's more than 700,000 sales. Tesla does not report sales by country, but China accounts for a big chunk of its global sales. In the first 6 months of 2023, BYD has already sold more than 1.2 million EVs. Last year, BYD sold more than 1.8 million EVs. So this year, it has a goal of selling at least 3 million vehicles. To do that, BYD will have to sell roughly 290,000 a month in the second half. Net profit for the first 3 months of 2023 was 4.13 billion yuan, up 410% from a year earlier. On revenue, up 79.8% at 120 billion yuan. Okay. Business outlook remained upbeat. BYD has made inroads into various foreign markets, including Southeast Asia, Australia, Europe, Middle East, and Latin America. BYD is also building its first overseas plant in Thailand, which boasts the biggest auto market and car manufacturing hub in Southeast Asia. It will invest $620 million to build an industrial complex in northeastern Brazil, comprising 3 plants to manufacture chassis for buses and electric trucks, assemble EVs, and produce lithium iron phosphate, a key material for EV batteries. So this Brazilian project will start operations in the second half of 2024. One dampening factor is Warren Buffett's flagship company, Berkshire Hathaway, has been reducing its holdings in BYD. It has cut its holding to 8.98%, less than 9%. So as its holdings continues to decrease, we expect the negative impact on the share price will be less and less going forward. Okay. This year, BYD share price outperformed the market. We reckon that if its share price corrects to the 50-day moving average, around 258, 250 would be a good entry point, 250. Our near-term target will be 280 Hong Kong dollars, and medium-term target is 300 Hong Kong dollars. Okay, the other, we have 2 topics among EV makers in China. Besides BYD, our other topic is Li Auto. Li Auto delivered 34,134 vehicles in July this year, representing an increase of 227% year-over-year and surpassing the 30,000 mark for the second consecutive month. So the cumulative deliveries of Li Auto vehicles in 2023 reached 173,000 as of the end of July. For all of second quarter, Li delivered 86,500 vehicles, well above prior guidance of 76,000 to 81,000, and up from 52,500 in the first quarter. It has already surpassed its total 2022 deliveries in the first half of 2023. As of July 31st, 2023, the company had 337 retail stores in 128 cities in China, as well as 323 servicing centers, and Li Auto authorized body and paint shops operating in 222 cities in China. For the third quarter, Li aims for monthly deliveries for the L8 and L9 of more than 10,000 each, and hoping to hit 50,000 monthly sales of the L7. So the three models will add up to around 30 at least 35,000 a month. For the fourth quarter, Li is looking for overall monthly deliveries of more than 40,000. We will also roll out its first all-electric model known as Mega minivan in the fourth quarter, which the price is in the range of 500,000 yuan, which is considered high-end pure all-electric EVTs. Okay. Financial highlights. It released its first half result yesterday. Total revenues were 47.44 billion yuan in the first half of 2023, representing a 159% year-over-year increase. Net income was 3.24 billion. So among the three startups, it was the only one that was making a profit. New and Xiaopeng were still loss-making. Net income was 3.24 billion yuan in the first half this year, compared with 651 million yuan net loss for the first half last year. Gross profit margin decreased from 22.1% for the 6 months ended June to 21.2% for the 6 months ended June 30 this year, mainly driven by the decrease of vehicle margin from 21.8% to 20.5%. But it was mainly impacted by Li1. Sorry, there's also again another typo error here. It should be Li1, O-N-E. He has ceased production of Li1, so that has a temporary negative adverse impact on the gross profit margin. If excluding the impact of Li1, the vehicle margin remains stable. The company has a strong cash finance condition. Cash and cash equivalents increased by 26.2% from 58.45 billion yuan last year, as of December 31st last year, to 73.77 billion yuan as of June 30 this year. Third quarter deliveries expected to reach 100,000 to 103,000 units, up 15.6 to 19% from the previous quarter. And monthly deliveries will hopefully hit 40,000 vehicles in the fourth quarter as the company accelerates the launch of new models and also ramp up production capacity. Okay, business outlook. In terms of autonomous driving, Li expects to release its city NOA for beta testing in its full-stack self-developed Li Max 3.0 in the second quarter of 2023, and targets to roll out in 100 cities nationwide by the end of 2023. It has introduced its 800-volt fast charging solution, which allows its BEVs to achieve a driving range of 400 kilometers with around 10 minutes of charging. So it's fast charging. Just 10 minutes charging will support a driving range of 400 kilometers. It also plans to establish a model portfolio of one super flagship vehicle, which is the Mega model I mentioned just now, 5 EREVs and 5 HPC BEVs by 2025. Now he has one manufacturing base in China, in Changzhou, currently produces its EREV models. So to expand its production capacity and prepare for the launch of its BEVs, it is constructing a manufacturing base in Beijing. It also plans to build over 300 charging stations along highways by the end of 2023, and will strive to expand its charging network to 3,000 charging stations by 2025. Okay. Li Auto, its share price clearly outperformed the broad market, but now after the release of the results yesterday, its share price saw a correction. It dropped to around $158, $160. So we expect some correction in the near term, which is good to the share price of the company, because it has risen too much and too long in the last 3 months. So it's good to have some correction in the share price before rising further in the rest of this year. So last part of our presentation is our take on A.T.M.J. Alibaba, our near-term support is 92 Hong Kong dollars. The next support below is 87 Hong Kong dollars. Near-term resistance is expected around 100 Hong Kong dollars, and the next resistance level is will be 108 Hong Kong dollars. Financial highlights in the first quarter. You'll release its second quarter results tomorrow. In the first quarter of 2023, revenue was 208.2 billion yuan, an increase of only 2% year-over-year. Direct sales and others revenue under China commerce decreased by 1%. As I mentioned earlier, it has entered a rather low growth phase. Now it has its growth has decelerated. But there are still some fast-growing segments, such as China. Revenue from China grew 18% to 13.6 billion yuan in the first half, primarily driven by increasing revenue per order from international fulfillment solution services, as well as increasing demand from consumer logistics services. Its cloud segment, once a fast-growing segment, now is under severe competition from Chinese telco operators, namely China Mobile and China Telecom. So revenue from the cloud segment saw a decline of 2% year-over-year, and income from operation decreased 9% year-over-year. The board has approved a full spin-off of the Cloud Intelligence Group via a stock dividend distribution to shareholders. So we expect new listing of some of its subsidiary going forward, mainly in Hong Kong, I think, which will include its cloud business, its China subsidiary, as well as Ant Financial. So this will also do good to the IPO market in Hong Kong. Okay, business outlook. Chinese regulator for Tencent, the share price is in move sideways so far in the last 3 months, between 320 and 360. So we expect near-term support around 335, and the next key support level is 320 Hong Kong dollars. Near-term resistance 360. The next resistance is 375. First quarter financial highlights. Revenue increased by 11% year-on-year, slightly faster than Alibaba. Revenue from value-added service increased by 9%, among which international games revenue increased faster by 25%. Revenue from online advertising recovered, increasing by 17%. Revenue from fintech and business services increased by 14% year-on-year, primarily driven by the recovery of commercial payment activities due to a consumption rebound in China in the first quarter and increased sales of certain cloud services. Okay, profit attributable to equity holders increased by 10%. Not very impressive, I can say. Business outlook. Chinese regulators granting a batch of new game licenses signals that Beijing was easing its crackdown on the gaming industry. We expect stable growth in revenue and faster net profit growth, primarily due to favorable revenue mix, and also increased revenue contribution from profit growth businesses, and better operating leverage and lasting benefits from cost control measures. Meituan, you can see that its share price rebounded recently from 109 Hong Kong dollars seen in end of May, but it saw resistance around the red line. The red line represents the 250-day moving average. So the near-term resistance is around 150 Hong Kong dollars. The next resistance will be 165 Hong Kong dollars. Near-term support around 138, and next support is expected around 128 Hong Kong dollars. First quarter revenue increased by 26.7% year-on-year. Profit was 3.4 billion yuan, turning from loss into profit on a year-over-year basis. Adjusted EBITDA was 6.3 billion yuan, reaching the highest level in the company's history. But economic recovery slows down, especially in consumption, which is not favorable to Meituan, and also competition is rising. For instance, ByteDance, Douyin is testing food delivery in China, suggesting it wants a slice of the market, which was worth $66.4 billion US in 2022. And as competition heats up, Meituan will continue to increase aggressive strategies such as discounts and rebates, which will affect its profit margins. Its revenue is expected to grow by 22% each year over the next 3 years. But meanwhile, the rest of the industry is forecast to expand by a faster rate, 36% per year, which is noticeably more attractive. Its price to sales ratio may fall to levels more in line with the growth outlook. So we're not very upbeat on Meituan at the moment because of competition and also slowdown in its growth. In order to raise its growth rate, Meituan expand into overseas market. It launched the Kita brand meal delivery service in Hong Kong in May this year as its first stop to expand outside mainland China as growth slows at home. But it takes time. It's still too early to tell whether it's a right move or not. Okay. JD, last but not least, JD, similar to Alibaba, is facing rising competition from Pinduoduo and other e-commerce operators, also from companies like Kuaishou and NetEase. They are also expanding into the e-commerce area. Near-term support is expected around 148 Hong Kong dollars, and the next support is 138 Hong Kong dollars. Near-term resistance is 165 Hong Kong dollars, and the next resistance 174. Okay. First quarter financial highlights. Net revenue increased only 1.4%, very slow growth, similar to Alibaba. Net product revenue decreased by 4.3%. Because of competition. Net income attributable to company's ordinary shareholders was 6.3 billion yuan in the first quarter this year, compared to a net loss of $3 billion for the same period last year. But the operating margin was quite low, only 4.6% operating margin. Okay. Because of rising competition, in early March this year, JD launched a 10 billion yuan subsidy campaign to compete against rival Pinduoduo, which signals competition is heating up. We expect more subsidy is needed that will eat into the profit margin of the company. Okay, business outlook. Faces mounting challenges to its e-commerce business amid competition from Pinduoduo, ByteDance, Douyin, and Tencent-backed Kuaishou, and slumping demand for big-ticket items like electronics and appliances, which make up half of its sales. it may be under pressure to launch more subsidy campaign, following the launch of 10 billion yuan subsidy campaign in early March to compete against its rivals. And its chief executive just retired in June due to personal reasons, replaced by the CFO Sandy Ran Xu. This surprise move will unlikely change operations though. Okay, so this ends my presentation tonight. Now let's get back to Brian.
All right. So thank you, Mr. Rees, for your wonderful speech. Your speech truly enlightened not only us at Phillip Capital, but also the audience with knowledge and wisdom on Hong Kong strategy and stock picks. Now, we will move to Q&A session. You may type your question in the chat box, and I will address your question to Mr. Rees. So, Mr. Rees, I did have some question here. Mr. Rees, one of our audience asked, what is your opinion that IPO are mostly overvalued? And this statement also mentioned by Warren Buffett.
Which one? But which company? Sorry, I missed that.
The question is, what is your opinion that IPOs are mostly overvalued? IPO.
It depends. Yeah. It depends on the market situation. Of course, in a bull market, I do admit that IPOs will tend to be overvalued, and they may see their revaluation over time to a more fair value. That may, but as long as this company can deliver in terms of business growth, its earnings continue to grow, so you also justify the higher valuation.
Thank you for your insight, Mr. Rees. We will now entertain a few more questions from the audience. So we did have one question here as well. One of our audience asked, any view on the HKSE stock Nagacorp?
Which stock, sorry?
Stock Nagacorp. Yeah. NAGACORP, Nagacorp.
Oh, Nagacorp. Okay. It will. We expect a relatively slower recovery. Although now post-COVID, I think everything is back to normal, but we see though because mainly from China, the VIP, the big gamblers from China, because of the weakening Chinese economy and also the crackdown on money laundering, as well as forex control on forex remittance will adversely affect the recovery. It will. I do expect its business to recover, but slower recovery is expected.
Thank you very much, Mr. Rees. We will definitely put that information to good use. Now, due to time constraint, we will only be able to entertain one more question from the audience. One of our audience asks, since some countries started to dumping US dollars, we call this as de-dollarization. So he wished to ask, is there any chances that Chinese yuan really will replace US dollar one day in the future?
Well, it may happen, but not in the near future. It will take quite extended period of time. But we see the trend starting. Because first of all, China's yuan is not freely floated yet. So I think the first step is for the yuan to be internationalized. It's not yet internationalized. So it will take time for China for the yuan to be completely freely floated. And then the positive trend is now China is using the yuan to settle its trades with certain trade partners, for instance, Russia and the Middle East. But as long as US remain the one of the key trade partners to many countries, and also the central bank reserve will continue to invest part of the reserve in US treasuries. The US dollar will continue to play an important role. So the US dollar, this trend, we do expect it will not happen in the near future. It will take a rather long period of time.
Agree with you, Mr. Luis. Thanks for your thought-provoking answers as well. So that's all for our Q&A session. Unfortunately, we have come to the end of today's webinar. As that's all we have for today, a huge thank you to the Executive Director and CIO of Phillip Capital Management Hong Kong, Mr. Wong, and the team at Phillip Capital Cebu branch for putting this event together. We would like to send our heartfelt gratitude to Mr. Wong for taking the time to be with us today. We would finally like to send out another huge thank you to our participants for committing and joining us till the end here. So next, if you are interested to know more about us, you can connect with us on Facebook, LinkedIn, or YouTube by searching Phillip Futures Sdn Bhd and Telegram by searching Phillip Futures. Do like and subscribe our page if you haven't. We will consistently update our events, promotions, announcements, and other marketing activities. That's all from us now. Thank you all for your time. We will be sure to keep you all in the loop for all of Phillip Capital's future events. Thank you.